China has abruptly delayed the announcement of its quarterly economic growth, which had been due on Tuesday. And this as the ruling Chinese Communist Party holds its key congress, where its leader Xi Jinping is set to start a historic third term in office, renewing his presidency for the next 5 years and possibly beyond. So what does this mean for the Chinese economy, which has been losing steam in annual growth and has been riddled with structural issues in recent years? For more, we turn to Mattie Bekink, China Director of the Economist Intelligence Corporate Network. Thank you for joining us again, Mattie. It's lovely to see you again.
Great to be with you. Thanks for having me.
Well, all eyes are on this National Party Congress over in Beijing, and many observers were actually expecting the CCP to declare an end to the zero-COVID policy, which was regarded by many as quite disastrous. But Xi Jinping, of course, he's lauded it rather as a success story, and he didn't even mention the property crisis. But, well, let's focus on the zero-COVID policy first. I mean, what has been the impact of this policy? And if the CCP continues with it, then what's it really going to mean for the Chinese economy?
So you're correct that there was some sort of speculative wishful thinking before the party congress that we would see signals of a shift in this policy, which has essentially been wreaking havoc with the Chinese economy. Instead, President Xi's speech made very clear that zero COVID is here to stay, and the party will continue to put, quote, the people and their lives above all else. He also used the language of struggle in relationship to zero COVID, saying that the, quote, all-out people's war to stop the spread of the virus will continue even if, and this is my analysis, even if it has been damaging the economy. The truth is zero COVID has really stomped on consumer and investor confidence in China. I do not see a real economic turnaround becoming possible without abandoning the policy. We also don't anticipate at the EIU, the Economist Intelligence Unit, that the policy will be relaxed in the immediate future. As you said, it's very clear that they're continuing with it. It's associated closely with Mr. Xi personally and used as evidence of his valuing the lives of the Chinese people. To me, there are other headwinds facing the Chinese economy, as you noted, particularly the property sector, and I look forward to discussing that as well. But zero COVID, above all, I feel almost has a chokehold on growth at the moment. And so we don't see an economic turnaround really gathering steam until there's a real shift in the policy.
Right, it does seem quite unfortunately that Mr. Xi will keep powering through with this zero-COVID policy. And, well, the way that Chinese authorities have been responding to the pandemic has been quite different from how they responded to the previous economic crisis back in late 2008, when China introduced the largest stimulus package in the world in the wake of the global financial crisis, of course. But we didn't see anything like that during the pandemic. So why was this the case?
Well, it's an excellent question, but in some sense, it was not necessary. I think it's very important to remember that the zero COVID policy was extremely effective for China for the first 2 years of the pandemic. Uniquely, China's growth never dipped below Q4 2019 levels. And despite taking a short, hard hit early on, China's recovery was swift. China's stimulus package in 2008 was actually crucial in helping the global economy recover from the financial crisis. And until Omicron, China was again the greatest source of global growth and kind of leading the global recovery coming out of the pandemic. This is also, I believe, partially why the current slowdown in China feels so remarkable. China has been the largest and most reliable source of global growth for the last 2 decades, accounting for some, I believe, 25% of global GDP growth during that time. So they didn't kind of need a big stimulus package in response to the pandemic because zero COVID was effective.
And, well, the other key issue, the property sector in China, it's been seeing a vicious circle of indebtedness, lower confidence, growing number of mortgage boycotts, and a further slump in sales. While Chinese regulators are doing what they can to stop it from collapsing, of course, is this pretty much the end for property developers, do you think? I mean, what do you think will be the long-term effect of this on the wider Chinese economy?
It's a great question. The long-term effect essentially will have to be a reconsideration or restructuring of the property sector, not unlike kind of the slowdown in growth being difficult to wrap your mind around because it's not what we're used to seeing from China. You know, for decades, the property industry has been symbolic of China's rise. We've seen private entrepreneurs have made fortunes. Average people have seen their net worth soar as home values have been dramatically increased, in some cases trebled, and local governments, of course, have generated revenue by selling land to developers. It's important to note that a remarkable 70% of Chinese household wealth is now tied up in real estate. So that's, as you noted at the outset, part of the reason that the property sector slowdown is really undermining trust in China's growth model overall. Reviving trust in the system is actually crucial for the government right now. Yet the government's response so far has seemed disjointed and slow, and it seems sometimes as though officials are overwhelmed by the complexity of the situation. So to regain faith in the housing market, what we'll need to see is the stalled projects finished, construction firms and workers reimbursed, and investors paid back on fixed income products. All of this, of course, needs to be accomplished without re-inflating the unsustainable debt balloon that led to the leveraging of the property sector in the first place. So that's no easy task. So far, the central government has taken some actions, of course, but you've also seen a lot of actions at the local level. The real question is, will the government step in as a lender of last resort for the stalled projects? And we might see that eventually. It might come to that to kind of prevent a complete collapse in the sector, but we have not seen that yet. And I think if you were to look at what the government will prioritize overall, I believe that home buyers and homeowners will be protected, for example, above some of the international bondholders who have already been hit by the defaults of some of the big property developers, just because it is so closely linked to social stability and also individual fortunes in China.
And well, very dim prospects for youth there as well, who are just struggling with youth unemployment. And well, China's entrepreneurship, it's been amazing the world since the mid-2000s, but now growth has been slowing in recent years, and badly placed reforms, they've hurt market confidence. Not to mention Xi Jinping, he's been cracking down on leading business people. Do you think the CCP is going to reverse some of its policies, or do you think it's going to become even more controlling?
I don't think we're going to see a reversal. The spate of regulatory and policy actions that we saw starting in 2021, focusing, as you note, on China's effervescent tech sector, where you had, the new national champions of China, these very innovative tech firms, but also other areas. This really reflected, I believe, the central government's confidence that it could make policy choices to shape the economy and society it wants for the future, one grounded in principles of self-sufficiency, national security, and social fairness. And so that's part of what this crackdown is really about. That said, maybe on the tech sector, we're kind of seeing the beginning of the end. Earlier this year, there was some indication that the pain of this kind of spiraling tech sell-off that we saw in the markets, I believe at its deepest, it wiped out more than $2 trillion in overall market value, was becoming maybe too much. In March, China's state news agency Xinhua published a report from a meeting of the central government chaired by Liu He, China's top economic advisor. And that report noted that there would be a, quote, rectification of large Chinese technology companies, or that the rectification, would come to a close, and that new regulations should be more transparent. Mr. Liu was supposed to have urged that policymakers be cautious when implementing rules that might hurt the market. So that's kind of a positive indication that perhaps, again, we're at the beginning of the end of the tech crackdown. And it has been more stable since the spring. Of course, China's been grappling with other problems, including the Omicron outbreak since then. That said, I believe that a reversal is not in the card. China wants its tech to be aligned with national priorities.
And well, Xi Jinping, he said that China is going to give unwavering support to the private economy and let the market play a decisive role in resource allocation. But there's still no single unified national market in China. I mean, is it going to be easy to prop up domestic consumption?
The short answer is no. Boosting consumption has not and will not be easy for China. Weak consumer spending has long been a feature of the Chinese economy, with private consumption's share of GDP well below global average, and even well below the average of other exporting countries like South Korea, for example. The plans announced some months ago by Beijing to build a unified domestic market were designed to make even as China is ramping up efforts to make the economy less dependent on the outside world and focusing on self-sufficiency, to also make the market a bigger magnet for global firms and investors, with emphasis on more efficient production, distribution, circulation, and of course, consumption. The plan, however, was short on details, and I think the hurdles to realizing a single unified market in China remain high due to favoritism and local protectionism. These are issues that are kind of evergreen, particularly for foreign companies trying to operate in the China market. And we have not seen measures taken to kind of resolve those issues.
And while China's currency, it's recently slid to a new low against the greenback, and that's not been seen since the global financial crisis. And that's came despite the Chinese central bank taking steps to prop up its value. How is the stronger dollar affecting China's financial stability?
It's an excellent question. So it's been kind of a volatile time for the renminbi. Just before China's Golden Week holiday at the start of October this year, we had the People's Bank of China, the PBOC, kind of issue an admonishment not to bet against the RMB. We had dramatic headlines declaring that the PBOC is bringing out the big guns in propping up the currency, as you noted. And we also had a spate of analysts fretting about a repeat of 2015, when a very poorly executed devaluation of the yuan provoked capital outflows that really further undermine the currency. However, for now, I think that a rerun of that situation is unlikely. First of all, the yuan is no longer overvalued. Adjusted for inflation, it's about 10% below its fair value, according to the Institute of International Finance. The yuan's target zone is better managed by Beijing, and its capital controls are better enforced. In the past, China kept its currency anchored to the dollar because it feared that a conspicuous drop would trigger a run on the currency. The yuan's decline against the dollar is now less likely to become disorderly. So for that reason, China is actually trying a bit less hard to prevent it. So even if we've seen the renminbi decline past basically psychologically important thresholds, in August it crossed 6.8 to the dollar, close to the level at which the yuan was pegged after the global financial crisis of 2008 to 2009. And then on September 26th, the central bank set the fix at more than 7 yuan to the dollar for the first time since the very early stages of the COVID-19 pandemic. So this indicates a little bit that China's policymakers are more relaxed and confident in their ability to kind of control the yuan. So I am not as concerned about this as I think the more dramatic headlines would make you believe that we should be.
Right, and over the past 2 decades, the world's just been astonished at China's economic progress, its leaps and bounds that it's made, as the Chinese say, in the second largest economy in the world. But it grew just 0.4% in the second quarter from a year earlier this year. And well, do you think the days of recording, 8%, such as 8% year-on-year growth, do you think those years are over for China? I mean, even before Xi Jinping took power, there were already debates over whether the country would be able to avoid this middle income trap. But what's your outlook on the course of China's economic growth in the long run?
Mm-hmm. The outlook remains complicated and is fairly bleak in the short term. I think it's important to note, for some of the issues that we've talked about already, that first of all, China's economic slowdown was inevitable. You can only sustain those extremely high levels of growth for so long. And we even had in 2021, economic czar Liu He note that the growth of at all costs era was over, and that they were more interested in the orderly development of capital, and again, shaping an economy that's more sustainable in the long run, not relying, for example, on the property sector to inflate growth or being fully reliant on exports. So even if China's economy may have already bottomed out in the second quarter of this year, however, the recovery remains fragile. The slump in the property market shows no signs of easing. Global demand for Chinese goods is slowing. There's a slowdown everywhere, not just in China. The number of COVID cases is rising, and the currency, as we discussed, has been falling. So at the Economist Intelligence Unit, we're forecasting about 3.3% GDP growth for China in 2022. We're more optimistic than many. So I think overall, with the COVID challenges continuing, the property sector challenges continuing, the short-term outlook remains complicated. Hope springs eternal that coming out of the Party Congress and, of course, the 2 sessions next year, we'll see more effective stimulus measures, probably focused on consumer technology, especially critical technologies, automotive and infrastructure. But no country, not even China, can maintain high, politically predetermined levels of GDP growth in perpetuity. The slowdown was going to happen. It's been made more painful by some of the global headwinds and some of the policy choices that we've seen in China, particularly zero COVID and the response to the property sector crisis. But we're not going to be going back to the days of China, quote, growing like China, growing at this extremely high level. China will continue to grow. It's still going to be an important market and a very consequential player in the global economy and an important source of growth, but not at the levels that we've seen previously.
Right, so it seems that the CCP is hoping that party ideology and party politics will somehow be able to override the market dynamics, but we'll have to see how things go in the years to come. That was Mattie Bekink, China Director of the Economist Intelligence Corporate Network. Thank you very much for your time.
Thank you.
And a big thank you to our global viewers around the world. Thank you for tuning in. We'll be back on Thursday, Korea time, with the latest insights on issues making headlines around the world. Thank you very much for watching.